Right, first presenter with results yesterday, so a very topical update coming on NWF from CEO Richard Whiting and Finance Director Chris Belsham later on.
Thank you very much indeed.
There we go.
Right, so good evening ladies and gentlemen. What we're going to do is give you an overview of the group, why we're a good company to invest in, sort of bring you up to speed on our latest performance. Before I do that, we're actually going to run a short video which just gives you a flavour of NWF, what we're about. Quite a big business, lots of trucks, lots of people, so the video hopefully will be self-explanatory. Okay, great. So thank you very much. So the video hopefully shows you some of the key facets of our business. Quite a big business, and clearly distributing fuel, food and feed around the UK. I'll just give you some of the big dimensions of the company. So we're actually old established, over 125 years old, established in 1871. And the origin and history of the group, it was a farming co-op, but it became a public company in the 1980s and then listed on AIM, one of the first companies in the Northwest, in 1995. Our market cap today is around about £85 million, and we have quite a significant amount of scale. So our revenue is 611 million. That flatters us because a large part of our revenue is oil, and half of the revenue of oil is duty. We'll come on to explain more about that in a few minutes. Gross assets, 141 million. The site you saw, we own the house, so we own the site. And the assets are very useful because it gives us security, so Chris and I can sleep at night. But critically also it gives us access to low-cost sources of funds because there's a lot of security for lenders to back us with. The results, and these were the results last full year, which was to May 2018. Chris and I have been on the road just now, we're doing our half-year results. But for the full year, we delivered operating profit of 10.6 million and headline PBT, which is the key metric for us, which is a record at 10.2 million. We have a progressive dividend policy, and the dividend that we paid last year gave a yield at the time and still around 3.6%. In terms of employees, at the end of the last year we had 957. Today there's actually over 1,000 of us, about 1,005 at the end of last month. So a business of quite some scale, and we're a UK-only business, and these give you an idea of where our locations are across the country. NWF originally, the original name was Northwest Farmers, because it was a farming co-op, but clearly we're a national business, so it's just NWF Group. This is our main site, so this is in Cheshire, just off junction 16 of the M6, just north of Nantwich, and this is where each of our businesses is based, and we own the freehold site. So that's on our books at 25 million, which is a reasonable value, and that sort of says, you know, we own the house, and that gives us that level of security. In terms of a few of the key sort of highlights of the group, first of all, we're doing some work looking at our returns. So total shareholder return is a key thing that we focus on as an executive team and as a board. And positively, if we look at the last 1 year, 3 years, 5 years, or in fact 10 years, on total shareholder return, we've actually outperformed the FTSE 100. Now, the reason we do that principally is because of the dividend policy we have. We've got a progressive dividend policy, and we've increased it in 9 of the last 10 years by about 5% each year. Analysts would also have us down this year to increase it by another 5%, and we're comfortable with that at the half-year stage. So that gives a good yield. We also have share price accretion, which has supported that total shareholder return. We've got a large facility. This is where the assets come in. So we've got a £65 million facility. We work with RBS, and that's through to 2023. So it's a long-term source of funding. And at the year end, our debt to EBITDA was 0.4 times. It's a quieter time of year in May. Busier now, we're in November, so we've just done our results, and we're 1 times EBITDA at the half year, which is a number that we're comfortable with. And you've got on there, we said as a board, we're comfortable in the range 1 to 2 times EBITDA. For what it's worth, our bank covenants are 3.5 times, so there's plenty of room within that. I think importantly, we always try to establish appropriate expectations, and we've met or exceeded expectations in 10 of the last 10 reporting periods. So what we're trying to do as a business is do what we say we'll do, and hopefully just do it a little bit better, a little bit quicker. In terms of our market positions, we're in quite large markets. I'll come on to talk more, but we're number 2 in the UK in feed, and this is animal feed, and we're number 3 in the UK market for fuel oil distribution. We're also in 3 different markets. We could sort of present a bit of a story that we're an integrated agri-food business, but that would really be stepping it too far. We've got 3 separate businesses in 3 separate markets, and that gives us some risk reduction. So for example, we had a very dry, warm summer, so there wasn't much heating oil sold, but guess what? Dairy cows needed more feed because there wasn't enough grass. So one business can offset another. We've also got a reasonably experienced leadership team. I've been leading the group for 10 years. Chris joined us 18 months ago. So what we've got is an experienced team, but we complement it with additional skills and resources. What we've also got is a very clear strategy, which we'll start to take you through, and an opportunity to accelerate the progression that we've got. Just a little bit of the history, and this is sort of going back probably over my 10 years. If I go back 10 years ago, we were a bit of a conglomerate, fairly non-focused business. The easiest thing is we were a retailer, we were a distributor, and we were a manufacturer. We actually had a chain of garden centres at the time, so we're clearly into different markets. It was a bit confusing. Critically for me, we had £53 million of debt, which is 5.5 times EBITDA. So cash is king, and therefore critically we want to get those debt levels down, which we did in the early days. We then started to get some focus in the middle of years, improve our working capital. We've generated over £25 million of free cash flow in the last 5 years, so clearly focusing on sustainable working capital positions. And now we're presenting ourselves as a focused distributor of fuel, feed and food. Fuel, feed and food, yeah. So we've got a clear strategy, we've got our banking facility, and therefore we're ready to move forward from here. Just take you into each of the businesses to give you a flavour. So this is, first of all, this is fuel. So in terms of fuel, what do I mean? Half of it is road diesel, so 50% diesel, about 25% is gas oil, also known as red diesel, and then about 23% is heating oil or kerosene. So I live in the countryside up in Cheshire, so I've got a tank in my garden, and 2 or 3 times a year we'll fill up my tank with kerosene, and that heats my home. And there are 1.4 million homes in the UK that use oil to heat them, and it's actually the lowest cost source of home heating today. And what we have are 20 depots around the country. And each of these depots operates within about 20 or 30 miles from its range. And we've not got big Arctics. These are the tankers that we have. And we've got just about 100 of these tankers based in the depots around the country. It's a bit small on here, you'll see it in your packs, but it's a very, very fragmented market. So number one in the fuel market is Certas, we're number three. So number three in the market, we've only got a 2% market share. And this big grey area here, or blue area here, 76% is other companies. So it's a very fragmented market. There are lots of small family businesses here. So the great thing for us, it's an opportunity to consolidate the market. So as we can acquire these businesses, we can increase our scale and get better returns. And Chris will come to talk about some of the metrics in fuel, but all we're trying to do is make a penny a litre of net profit. But if we make a penny a litre, that's over a 30% return on capital. So it's a very strong performance. Track records here, so again a little bit small, 330 million litres, now up to 540. And that's pretty much all been done by acquisition over that period as we've expanded the network. Our strategy is to expand this further. We're operating within Great Britain. And as I said to analysts yesterday, in terms of looking at businesses, I have been to Inverness and I have been to Plymouth. So we're looking at the opportunities here to consolidate this market further. But then look at food, and slightly different business here. This is consolidation of ambient grocery. So what do I mean by that? Some of the products you can see there, but if you ever buy Thai food tea, if you ever buy Lavazza coffee, if you ever buy UHT milk from Arla or Applause pet food, it's come via us. And we're not buying and selling the food, we're the warehousing and distribution arm for those businesses. So up in Cheshire, in this facility, we've got nearly 1 million square foot of warehousing. And in there, we've got 100,000 pallet spaces that we're storing ambient grocery. And right here today, we have 100,000 pallet spaces filled on our site. So this whole facility is full. What we then do every day is about 120 loads on average of a full load going to the supermarket's distribution centre, or to cash and carries, or to whatever retailer the food manufacturers want us to do. And then we're charging perhaps £1.50 per pallet space per week to store it, and then perhaps £25 to deliver a pallet, whether it be to Asda, to Aldi, or to Tesco. And the key is this scale gives us good levels of consolidation, and then this is the lowest cost, most environmentally effective way of distributing groceries around the UK. So that's what the business is, and it's grown in size. These were added about 8 years ago, and we've got potential to increase the site further. And we're the largest consolidator of ambient grocery outside of the southeast, and therefore we have about a 30% share of the northwest market. So it's a good business, and it's contracted with big food manufacturers and the supermarkets, about 200 customers. Just out of point of interest, in this facility today, 100,000 pallet spaces, we currently have 5,000 pallets of what our customers are called Brexit protection stock. So some of our customers have decided to bring stock into the UK, typically importers, to protect themselves if there are any issues through the Brexit timing. So about 5,000 pallets there today. And we're holding that to support our customers through the period. Then move the third business, which is feeds. So this is animal feed, and it's a ruminant animal feed. And ruminant is multi-stomached animals. So that's a dairy cow, beef, or sheep. And what we've got on the map here is the small pinpoints, but each of those is a customer that we've delivered to in the last year. And you can see principally it's down the west coast of the UK, and that's because that's where the rain falls, the grass grows, and the ruminant animal lives. And the way of remembering this business is really easy. Dairy cow, we feed 1 in 6 dairy cows in Great Britain. That's the easiest way of remembering. What we've got is, this is George Franks, who's one of our team. He's a trained nutritionist, and he is advising the farmer on dairy nutrition. So when we had that dry period of the summer, the grass wasn't growing, he was saying to his farmers, you need to increase your feed rates because actually we need to maintain your milk production. So it's a bit like the dairy cow as an athlete, and we're advising the athlete how to perform. And her performance is measured 2 or 3 times a day when she's being milked. We're a business of quite big scale, so this is us here, number 2, with our 13% share of the total ruminant market. And we've got operations which are really well located in the UK. We're number 2, there aren't 150 players, there's 18 of us, and there are opportunities again to consolidate this market and acquire businesses. Although there are only 18, and we're very open, actually none of them are for sale today. but they're all aware that actually we would like to consolidate this market. And the other thing we're doing is selling additional products and services to these customers. We also have quite a lot of assets, so we have a mill. This is up in Longtown on the Scottish border, which is here supplying customers in the north of England. And in line with each of the three businesses, they're large, they're of scale, and these markets don't go up or down dramatically. So the global financial crisis, these markets were very stable. Okay, so I hand over to Chris, who's the Group Finance Director, who's going to take us through some more of the metrics and then the questions.
Thanks, Richard. I've recklessly decided to change the slide order in mid-flight, so we'll see how this goes. I think it's probably quite useful to understand the financial dynamics of the business model of each of the three divisions before we come back and look at the numbers. So if we go through each, the first thing that Richard touched on was that revenue is not a particularly useful metric for our business, and that's because the bulk of our revenue comes from our fuels and our feeds business. So what are we trying to do in fuels? What we're trying to do is buy fuel at spot price and sell it for spot price plus a margin. And we don't care whether we've bought that fuel for 50p or for £1, we're still trying to get the same 4, 5, 6p margin on it. So our revenue in the fuels business will go up and down, but actually as long as we can get that margin, that's all we care about. And we only hold about 2 days stock as a maximum, so it really is a trading business. In addition, 50% of the revenue for that business is just duty, so it's a straight pass-through. So as Richard's already mentioned, what we're targeting is an operating profit of just under a penny a litre. Now that will vary across the year because we've got quite high seasonality in demand. So in winter we have high demand for heating oil, and that means our fleet is used at a higher capacity, and therefore the margin on all of our products has to go up to compensate for that. And if Rich and I are smiling at the moment, it's because it's snowing in various parts of the country. That means there's a burst in demand for heating oil. That means our margins will be going up. So the impact last year of that was when we had the beast from the east, that created a huge surge for heating oil. Our margins lifted overall. So rather than achieving 0.9 pence per litre, which has been the average across the last 5 years, we actually achieved 1.3 pence per litre. And if you do the maths, that was about 2 million of extra profit that fell through. Moving on to our food business, a bit more normal in terms of how you look at that. So revenue here is a guide to activity. And in that business, we're targeting an operating margin of just over 5% and return on capital employed of between 3 and 10%. Ideally, I'd like that to be high single digit. There is some seasonality in that business. It tends to be around bank holiday periods. In addition, Swizzle's Sweets is one of our clients, so we have quite a spike at Halloween time. And then on to feeds. This again is a bit similar to the fuels business. So what we're doing here is buying raw materials, that's cereals, soya. We're manufacturing that into a product and then selling that onto a farm. So what we're trying to do here is achieve £50 per tonne gross margin. So we're really sort of within a range indifferent as to whether those raw materials cost us £180 or £200, as long as we can achieve that £50. So again, you'll see revenue goes up and down, but it's all about that margin that we're achieving there. Return on capital employed, aim in that business is to try and get that over 10%. There is seasonality again in that market. So in the summer, cows are out in the field eating more grass. In winter, they're in a barn and being fed our feed. So we have a spike in demand through the winter. So what does that actually mean in terms of the numbers? Well, this is for the last financial year. So you'll see our revenue last year was up by nearly 10%. Half of that was commodity price increases, but the other half was activity. And that activity dropped through to our profit numbers, which is clearly what we're really focused on. So headline operating profit, headline PBT were both up significantly at record levels, and that dropped through to a record headline earnings per share. Richard's mentioned the dividend, so we've been increasing that by 5% per annum in 9 of the last 10 years, and that reflects our confidence in the business and also in the cash generative nature of the business. So we've generated nearly 30 million of cash flow over the last 5 years. We typically say in a normal year that before any development expenditure, we generate about 2 to 3 million of cash. And that means our debt has reduced significantly. So the last year end, we were at 0.4 times net debt to EBITDA. And as Richard mentioned, we have 65 million of facilities available for development. The bulk of that facility is a 50 million invoice discounting line, and that's a very attractive rates. So when we looked to refinance that last year, we found actually it wasn't possible to beat the rates we were already getting from RBS. We do have a pension deficit. That's got a recovery plan over a sort of sensible time frame. We pay 1.8 million into that per annum, and at that level of cash flow is not constraining our ability to invest in the development of the group. So in terms of a bit more of an update, what have we been doing more recently? Well, we've been reducing net debt and continued that cost generation, and that means we've got ability to invest in future growth. Part of that's getting the right management team in place within the divisions to be able to do that. So we've brought a new managing director and finance director into our fuels business over the last couple of years, and we've added M&A experience into the group at head office as well. So in terms of the growth opportunities that exist, in fuels we are number 3 in the market with a massive 2% market share. There are 150 players smaller than us, and most of those businesses are owned by entrepreneurs who are looking towards retirement. So there's a big opportunity there to go around and consolidate that market at fairly attractive multiples. And we're starting to have those conversations with those parties. We did a transaction at the start of December, just after our first half, which is a business called Midland Fuels. In foods, the strategy is about optimising the customer mix that we have on our site to create more efficiency in the business. There's a shortage of warehousing in the UK at the moment, so there's the opportunity to churn that customer base a little bit to make sure we have a customer base that ideally matches the site that we have. And in feeds, again, operational efficiency is key. We've got a lot of assets there, and it's about how we can use those more effectively. But in addition, there's a real opportunity to consolidate that market. There are 18 other players. We're all based in similar geographies, and we're all driving past each other to deliver to customers next to each other's mills. So there's significant cost synergy savings if you can put those businesses together and take out a number of those transport costs. In terms of our half year that we're just reporting on at the moment, then we've delivered profit improvement in the first half, and as a result we are trading in line with board expectations, with net debt staying low. In fuels, what we saw was the hot summer meant the demand was a bit lower, but we managed our margin very effectively, and that meant we've been very well placed going into the winter, so we're very confident on the outlook of that business for the rest of the year. As I mentioned, we did a transaction just after the first half as well in that business, and we're continuing to have other conversations with fuels businesses. In food, we had quite a difficult second half to the prior financial year. We've turned that around now as we've bedded in new customers. It's a good performance. That was 0.1 million ahead of the comparative period last year. And very, very busy, as Richard's already talked about. And in feeds, we had a very busy summer because of the hot, dry weather. There was limited silage, so therefore farmers were having to buy more feed to feed to their cattle. That's quieting down a little bit going into the autumn and winter, but still the outlook for the business for the year is still positive. It wouldn't be a presentation at the moment without mentioning Brexit. Key point here is we operate in large, stable UK-only markets. So whilst, like any sensible business, we are talking to our suppliers and customers about the impact of Brexit, actually we're pretty comfortable about what that impact will be, and longer term, it shouldn't have a significant impact on the group. So the key points really, we're demonstrating strategic delivery with our fuels acquisition, and there's more of that to come. We continue to have a strong balance sheet to enable to finance growth. And then just in terms of outlook for this year, I think later in the pack we've got the analysts' numbers for the business. We're covered by 3 analysts, Expectations for this year is a profit before tax of 9 million. You'll note that's a little bit down on where we were last year. That's because it's based on normal winter conditions. Clearly last year we had the beast from the east. If we have another beast from the east, who knows where we may end up, but we always guide towards normal winter conditions. And again, analysts expect the dividend to go up by 5% again to 6.6 pence, which again at current share price is a yield of just under 4%.
Okay, so just final points to make. We're on AIM, we've been there for quite some time. If you actually look on our website or our annual report, there's a lot of governance structures around NWF. My background was in fully listed businesses before I joined NWF, and frankly I can't spot the difference in terms of governance, in terms of our non-executives and all of our committees. We've got a strong track record, as I said, total shareholder return outperforming the FTSE 100, which we're proud of, and we've got a progressive dividend policy with good yield. I think the key to point out is, we're solid, we're safe, reliable. Sometimes with Chris, are we dull? And dull can be good, but I think critically we are ambitious and we're looking to develop, and we have good, capable leadership teams. There's also opportunities, probably particularly around the fuel market, to accelerate growth and use the financing facilities that we've got. So that concludes the presentation. In the rest of the pack, additional information, more numbers, and those analyst estimates that Chris mentioned. So I think we'd be happy to take a few questions if there are any.
The other quoted UK company that I know of in the same sort of business area as you is Winstay.
Yeah.
Would you regard them as competitors, or and if so, I mean, how would their business model differ from yours? I mean, would you like to compare and contrast a little bit?
Yeah, Winstay have some similarities. They too were a farming co-op. They listed onto the AIM market, similar size market cap. They're different in the sense that they're more of a general supplier into agriculture, and almost all of their business is in agriculture. So remember, fuels and our food business are separate to the agriculture market, and therefore that gives us a more diversified business model. A difference in our feeds business, where we do compete with Winstay, is we're very narrowly focused. So we're ruminant only. They also do monogastric, so they supply poultry, and we're very focused on dairy. So we have a team of 50 nutritionists who sell directly on farm. The Winstay model is more around country stores, where a small farmer, typically in Wales, will buy a whole variety of products, a range of products from that store. We tend to just work with larger dairy farmers. We do about 600,000 tonnes. Winstay don't publish, but I think they do less than 300,000 tonnes of feed, but they have lots of other businesses. They have grain and other products they'll trade in the agriculture markets. But there are some similarities. A number of analysts follow both companies, and we're on a slightly higher return yield than them at the moment, but we'll see what happens.
A possible merger there sometime in the future?
Well, it's one where I showed you the market of feed players, and there are 18. They are one of the other 18. Okay. So absolutely, we'd be interested in discussions.
Two questions. First of all, is your business scalable Europe-wide, which might prove a hedge to Brexit if it's worse than you anticipate? So has the board looked at possible European opportunities for expansion? And secondly, what's your economic moat to stop others coming and taking your market share from you?
Okay. First of all, in terms of Europe, we haven't spent a lot of time looking at European businesses. We know how they operate in a number of our markets. But actually, in terms of, say, the fuels market and the food market, the feeds market, those are long-term sustainable markets in the UK. So there isn't a sort of a requirement to go overseas right yet. We may do in the future, because these are large markets in which we could gain share. I think within each businesses, what we have is a very specific offer, very much a branded offer, which is hard, therefore, to copy. So in the feed market, yes, it's an animal feed business, we're manufacturing. The critical bit is we're nutritional advisors. That's our USP, what our brand creates. In fuels, yes, we're a fuel distributor. It's a commodity, but we've got local depots providing fantastic service to local communities. So again, a branded proposition. Food business, actually we're a business of scale, 30% in the Northwest. So I think it's our branding and our branded positions in the markets which gives us benefits. I think whatever happens through a Brexit transition, these markets won't go down because they're very much actually linked to the population, and therefore they are long-term sustainable. The challenge will be for us to grow them, and we need to do that through targeted initiatives.
Barriers to entry?
Hi, I see on slide 19 that just under 20% of your company is owned by 4 shareholders whose names I'm not even going to attempt to pronounce. Who are they?
Okay, so there are 4 Icelandic pension funds. You can actually look them up, and they're listed businesses in the Icelandic market. They're a bit of a heritage. So in the early noughties, we had an activist investor, a company called Atorka in Iceland, who actually built a 25% stake. A lot of businesses in Iceland, they then went bump, and that stake was taken over by the Icelandic banks. And then the pension funds, who are now our shareholders, then invested in the stock. So it got split down into, it was actually 5 stakes. One of them sold out immediately, so it's been 4 individual pension funds. If they weren't with strange names, their English is great. We see them twice a year, just like we do pension funds in the city. They like what we are, they like the asset backing, they like the dividend, they like the growth, and they like the fact that we're a sterling asset because we're a hedge against their other investments. But they're just a normal pension fund in that regard.
I was interested in the possibility of a consolidation in your feed sector.
Yeah.
You said there was, I think, 18 other players. First of all, are they family businesses? In other words, quite difficult to acquire because often family wish to pass down through the generations. And if you could acquire one or more, how would you pay for it?
Okay, so in terms of the businesses, 3 are listed. So there's 4 Farmers, which is a Dutch listed business. Sorry, 3 apart from us. Cars Billington, which is Cars Group, which is actually fully listed, and then Winstow, which we talked about earlier. The rest are family businesses, and they're typically multi-generational. So some of them are 3rd, 4th, or even 5th generation businesses. We have been acquiring in this space. So, get my timing right, 3 years ago we bought Gympie Agriculture up in the north of England, which gave us the base, and we built the mill near Carlisle. And in terms of what we paid for that business, it was just under 5 million. And that represented about 6 times EBITDA. We've got a 65 million facility, and net debt at the year end last year was less than 10 million. So actually we can fund that through debt. But again, as a board, we're not going to over leverage. So we've said as a board, we're comfortable in the range of 1 to 2 times EBITDA. But whether it's the family businesses or the listed businesses, they are aware that we believe there are consolidation benefits, and they are hard synergies because we're driving past each other's mills to deliver to farm.
Can I ask one more?
Yeah.
Your pension deficit, presumably that isn't going to last forever as people pass away, and you're paying in 1.8 million per
That's
year,
correct.
I think. So when would you expect that to begin to tail off? Because I assume that the pension is closed for new members.
Yeah, the pension scheme was closed for new members in 2002, and it was closed to future accruals in 2016. And it is something that Chris and I manage. It's one of our key activities. Just to give you a flavour, the deficit at the half year that we just reported under IAS 19 was 15 million. And therefore our 1.8 million recovery plan is a 10-year recovery plan to get that back to parity. It will be a long-term liability of the group. We recognise that. There isn't some magic fix to this. We're paying an appropriate amount, which is 1.8, to get recovery in 10 years, and it's invested in various asset classes. So the critical bit is after paying that 1.8 million, we're still net generating 2 to 3 million of free cash. So it's not holding the company back. If in 10 years' time we've then recovered to 0, there'd be no additional deficit contributions, and that would give us additional cash flow.
Thank you.
Okay.
Right, can I thank Richard and Chris, and who will be around later on for any further questions. So,
Okay. Thank you.